Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. Today I'm one-on-one with Audrey Byrne from the research team at Onyx. Thank you, Audrey, for coming.
That's good. It's great to be here.
Bit of pressure. One-on-one.
Yeah. Just me. It's all on me.
So we're going to go back to, market discussion basically. And we thought we'd frame this around the new futures report you guys put together.
Yeah.
So let's just get straight into it, right? It starts in the summary pretty nicely, so we can just roll through it.
Yeah, I guess for anyone listening, we do have this new futures report. I think one of the biggest questions, no matter who we're talking to, no matter what product we're talking about, it's constant, well, what do you think Brent's going to do? What do you think TI is going to do? What's Crude going to do? That's what everyone wants to know. So I guess we've now created this new report.
That's a good context, actually, because we're very much oil swap specialists. It's very much linked to the physical. We think that's where all the information is, all the positioning is, and very telling of what's going on. Yeah. But people still just want to know about flat price.
Yeah, this is what's it going to do. I know I was talking to some fuel traders last week, and it was still, and we look at crude. They don't trade any crude, but they need to know what crude's doing.
Well, everything's priced off it. So
exactly. So it's that question, no matter who you're speaking to, that we always get. And I think it was that one thing we were missing, even ourselves as a team, because, we do have all of this kind of information and data, and we just have now put it in one simple to use place. So it's now a really kind of readable format. So I guess if we just kind of bring it back to actually what have prices been doing. So
the last time we spoke was a couple of weeks ago.
It was
quite a lot's changed since.
Yeah, I mean, it's just it's nearly a different market kind of landscape now. I mean, last time we were speaking, we were talking about the rally in gasoline was what was keeping all these prices supported. Gasoline is still obviously really, really strong. But, it's not on this kind of continuous rally anymore. Prices have actually corrected lower. And, we're seeing, I think, markets kind of more tentative now at all these really, really high levels. I think a really good example of this recently was actually in the fuel oil market. So we had, just a player in 380 spreads actually just started selling, and everything tanked on the back of this, and it fed into the European fuel structure, even though fundamentally the market is still quite bullish. There's still, tight sour crude supplies. So there was no necessary kind of need for it to sell off, but it's this herding mentality. Prices are looking high historically, and everyone just panicked and started selling.
Kind of across the board, right?
Yeah.
So let's frame it. So the regime, if you call it that, we were in a bit of a stagnant flat price environment. Brent and WTI around the low 80s.
Yeah.
And staying there really. Like every rally was kind of tapered, and every sell-off was kind of supported. So it felt like there's a lot of activity in the market not concentrating on the flat price. So for traders out there who look at just the flat price, that's why we love looking at structure, which is, time spreads of Brent, but also the oil swaps markets that are very much more linked to prompt physical. There's all these things going on behind the scenes, which are all telling you a narrative about what's exactly happening in the oil market. And even though it seems like nothing's going on, a lot was going on. Now it's flipped. Now everything's happening in the outright price. We've had a pretty serious rally. We're almost up to $90 again in Brent.
Yeah, it broke through 89 briefly yesterday. You had TI breaking through $86 a barrel. So that was a 10-month high in TI as well. Yeah. So that spread is actually, that spread narrowed as well. So that is in like the $2 per barrel ranges.
Sorry, as in WTI versus
TI
Brent.
Yeah.
And that's a whole nother thing to discuss.
It is,
but, But just to frame the discussion, it was the beginning of the year. Second half demand's going to be really strong. Everyone's bullish. Didn't really work out. Even during the OPEC cuts, people selling into it. We've had a very fragile sentiment since. And now, ironically, the idea of a fragile sentiment became the leading narrative. So I think that was really keeping a cap on things. But we have come out the back of this, of the latest OPEC cut, and we genuinely are performing in kind of all areas. High Brent spreads, good physical premiums and crude, good crack levels on gasol and gasoline, and the prompt, the flat price on a trajectory where now actually I think people are starting to believe we can get a meaningful rally, maybe back up to the psychological $100 per barrel again, and that's where we are, right?
Yeah, and there's all these kind of they're new narratives now, but they're old narratives creeping back in again.
That's
so
interesting.
As in when prices reach these high, you have this different narrative now. So in the beginning of the year, it was all about the second half demand. And I mentioned to you, and I was actually, if anyone out there has Redguard's book, it's chapter 3. But it was just, when you talk about kind of influencers in the market, and it was actually just yesterday, a senior official at Trafigura came out and said that these price spikes are due to low inventories and under investment. So that narrative has creeped back in, and it's something I haven't seen since last summer. So it's not something that has been there recently. Even when prices were moving up and up and up to 85, 86, it's not until they're now at this like 88, 89. It's oh, we've got underinvestment and it's going to go higher. And
yeah, and this is an interesting point, because you have this newfound momentum in the market, which has really struggled this whole time. So it's the media's job now, or the influencers' job now, if they believe in this position, it's about fueling the fire.
Yeah.
Now, it's very difficult to do, as OPEC found, right? Oh, we're going to cut. No one cared. Okay, finally they cut so much that people did start to care, and we did seem to get it in the reality of the physical premiums and things like that. But now you need to kind of, as an influencer, jump onto this and stoke the fire with what you've just said. So you think this whole underinvestment narrative is going to come back in. Obviously the OPEC cut narrative. Economic growth, though, is probably back on the menu.
Yeah, well, you've got another big thing actually in terms of like that kind of stuff. You had the US unemployment rate actually rising 3.8%. So now everyone's like, oh, no more interest rate hikes, which was obviously a really bearish narrative for a long time. And you do have the EIA stats coming out. Crude inventories have declined for the past 5 out of 6 weeks. A big move down last week. So as forecast for like 3-something million barrels drop, and it actually ended up being 10.5 according to EIA stats, 11-something according to API.
The US stocks are drawing in the midst of on the one hand, OPEC have a persistent cut, but then on the other hand, the US have the persistent, like, they've drawn from their SPR.
Yeah, and their oil rigs are like they were unchanged this week or in the most recent data, and they're at like a lowest level since like February. So again, it's another narrative that everyone's jumping on.
So we can see where this is going. I think it's gonna pick up in momentum. Well, the US still need to fill their SPR. There's things are just on a trajectory that you can't stop. The economies are roaring. So a counter to that would be, which was kind of another thing earlier on this year, which is but if oil prices get high again, then you get inflation, then you get the recession narrative again. I haven't seen much of that actually. It's been, I would say the difference is, again, this is why it's so important to look at things outside of just Brent and WTI flat price, because that might be in the CPI calculation, but in the US, etc. But in terms of real what's hitting people's pockets, is the retail price of fuel. And this time last year, when we're talking gasoline being strong, we're talking gasoline being $40 per barrel over Brent. And gasol astronomically high as well. So we're talking about like as much as $200 per barrel as the actual price people were paying, plus the duties, plus all the rest of it. So the funny thing is now, because the crack levels aren't in this inflated environment, they're actually high, but reasonably high on a historical basis. Then as long as that stays, okay levels, then flat price, ironically, as in Brent prices, can get higher without seeing this knock-on effect. You see what I mean? So the narrative would be like, no, you can't get long Brent, because if it gets to 100, we're going to get inflation. It's like, but if the cracks stay kind of low enough, and if the cracks are inverse relationship with this rally, then actually the market can sustain.
It can kind of, what's the word? Absorb.
It can kind of take it, right? Or the end user can take it. But then for the people buying the specific contract, Brent Futures, that's what I'm saying. It's a weird thing to think about, but you have to factor that in.
There was another, so actually it was Russell Hardy, so he's chief executive of Vitol, coming out and saying that, the whole supply situation is actually going to improve in the next kind of 6 to 8 weeks as, refineries start undergoing maintenance. That's going to be a whole other narrative.
Or to support cracks again. And
yeah, exactly. I mean, obviously we've seen refinery margins absolutely tank. I don't know if you saw like the Brent Dubai, or sorry, not Brent Dubai, the Asian refinery margins down like $2.
Yeah, so this is key though, I think. I think that's an example of a well-functioning market. It might not seem like it might seem like a bearish thing, but they're still highly profitable levels. And the thing is, does a refiner, if the refiner's net refinery margin is $5 per barrel, and then it gets to $8 a barrel, do they refine more oil when it's $8 versus $5? It's a trick question. It's like, no, whenever it's profitable, they're going to be 100%. So it doesn't really change anything. If anything, it's just, it's how it should be, right? If you're processing more crude, you're drawing from stocks, you're running at really high rates, then you should be translating that crude supply into product supply, and the cracks should remain at like reasonable levels and shouldn't blow out. As soon as you were to get cracks blowing out again, you've got a market out of control. And then you are genuinely, like 2022, completely in a net massively bullish market. And that's when you are getting to the point where you're like, well, should there not be more supply given we're in the midst of a cut? And you're getting back into that. But this time it doesn't feel like that. It feels like a lot more orderly. Does that make sense?
Yeah, even though the EBOB cracks are way higher than last year's levels. I think I was looking at kind of some trade ideas. I was looking at the November EBOB crack, and it's way above 2023 levels. So
well, that's when they got the sell-off. So the peak last year was...
But for this time last year, that...
Yeah, so I'm saying you got the sell-off in gasoline last year, the back end of the year. Gasol stayed high. Now you've kind of seen gasol not be as high, which allows you with the net margin.
I think the gasoline market's an interesting one right now because everyone's still tentatively bullish, but I think like what we saw in fuel, but more sustained when somebody starts coming in selling, because what we saw in the summer was consistent profit taking prices came down, but people scale back and profit taking prices came down. But I think this might be the last one, unless you get some like hurricane outage that actually takes
and that's
out.
what people are probably
banking on right now. It's
on a risk reward basis. It's like it's like an option trade, even if you're long gasoline cracks, it's a bit like an option because you're looking at your risk reward being like, it's a healthy environment, there's not too much downside, and if I'm long I might lose a bit of money, but the upside is huge if this one of these hurricanes that's battering the US at the moment does affect a refiner. It's going to blow out, so the risk reward is there, and that's why I think you'll have that length.
Unless it takes out a demand center, that's the only thing.
True, and that's always the perennial kind of problem looking at hurricanes. But let's look at the actual futures report that you were talking about, just so we can get a bit of context.
Yeah, so this is one of the kind of the first pages, and I think this is one of the bread and butter kind of pages of the report. So it's looking at the kind of technical analysis. So we've done it for Brent crude, gas oil, and also RBOB. And this is pretty interesting because I don't know if you've seen the latest CFTC stats, but actually in the most recent report, we saw length stopping out again in Brent, but this doesn't marry up with what was happening in the price of the week because it's so lagged. Whereas this data it explains kind of what the CFTC was showing that week, and obviously goes even further. So in the most recent CFTC data, like I said, we actually saw the long short ratio hitting a 5-week low. We saw short positions at a 5-week high in managed by money positions, so spec positions in Brent crude. So you have the shorts at a 5-week high, and in that week you can see it kind of nearing oversold territory, coming down here nearing that lower Bollinger Band, and then ripping back higher. So we're seeing new interest coming in. It's back into neutral territory, and it's up near this upper Bollinger Band.
So what you're saying is the CFTC report came out, and it showed on Friday, and
essentially showed data for this week here, where you can see this kind of overextension to the short side. So it's almost like a short saturated market. So it was almost primed for a reversal here. So people, and then this was only yesterday, and today you can already see like an updated version where we're nearing now overbought territory, and the price have ripped past that upper Bollinger Band. And you can see the open interest. So this is quite interesting. The open interest here kind of reaching a plateau and actually starting to come down, which is indicative of profit taking. And obviously now, since we're up at this like $89 per barrel level, profit taking is definitely going to be, very attractive for some players.
So for people looking for a reason out there, people love a headline, and that's fine. And you tend to have headlines linked to managed by money or, investment managers, their actions, their buys and sells. But remember, they're not a huge part of the market. The biggest players are the majors and the trade houses. They have the biggest volumes, and even the producers and refiners, enormous balance sheets. Now, what it looks like from the evidence and what you said there, but also the timing of it is, we approach Brent expiry. And again, another reason why you have to look at the swaps and you have to look at the time spreads and look deeper when you want to understand what's going on in markets. And what we got was a very unexpected bullish expiry of the Brent crude future, which is linked to physical prices. Now it's priced to physical that's loading in 2 months time, but they trade it on a physical differential basis. So obviously a flat or a backwardated or a positive physical differential was healthy. Now it was looking healthy, like 30 cents, but jumps out and clears at like 70 cents. Now that by any estimations is a strong market, right? A strong crude market. And I think it was unexpected. I think people didn't expect this strength that we've been seeing in the dated Brent markets post the OPEC cuts actually sustain at these high levels. But to go out and say, people really want those barrels at those levels in the future, way in the future, I think took people by surprise. So you got people in the managed by money market probably selling into things, or at least taking out their longs, maybe getting short, or at least the evidence was they're getting short. And then suddenly you had the trade houses and majors who've been pretty much on the sidelines, I'd say, for the past few months, particularly as the kind of long narrative didn't work out. You got a lot of exiting from what we've seen on the evidence from the cut in February or March, I think February. And so I think this was the first time trade houses and majors was pretty serious volume. We've got to make a pretty binary decision. Do we buy, hold, or sell? I think they've been holding, and they saw this expiry. I think the fundamental narrative has become a lot clearer. they base a lot of their things on supply and demand. Ultimately, shit, guys, this is serious. They all piled in very quickly, and I think that's why you got such an aggressive rally from 83, 84.
Yeah,
because with the long shorts reducing, that was getting to like 83, right?
Yeah, actually that was, and also I remember even last week, bullish stats came out for EIA and prices actually came down to like $83 handles.
Well, that's using a liquidity opportunity again.
Yeah.
So people were just getting so used to, I just can't go higher. But I think it was the trade houses and majors, which the CFTC report is kind of suggesting are the ones that took over this new length and this new buying. And then what happens is people start to go, oh, it must be something's happened. And you look at the momentum. There's a lot of momentum traders out there, like the investment managers, like the hedge funds.
Yeah.
And so it's likely the next report essentially will show
those people piling back into positions. Yeah, exactly. It's just a shame that it is so lag, but that's why we have this, because you can see this now in more real time.
We've also got our CFTC predictor, right? That's using our proprietary data and other data to try and say what is actually happening to the CFTC now, not last week.
No, as in, so we do it. We can do it for Tuesday, Wednesday, and Thursday. We release it on a Thursday because it's just the most accurate, because it will have taken into account.
Do you want to show that as well?
I can actually show you the review.
Might as well plug it.
Yeah.
So that's interesting. But you were saying now it's getting to overbought territory.
So this is actually our predictor review. So if we can bring that.
And again, that's another indicator that we got such an aggressive rally so quickly relative to recent times. This is always a relative thing. And to get a $5 rally, $6 rally, it seems like the new psychological level is probably actually $90. Actually, whilst we were pausing before, I actually read something on LinkedIn about someone saying, oh, it won't get much above 90 because of macroeconomic fears again. And this is just a narrative to cap it. But I don't really believe it. I think this time, as I say, the trade houses and majors coming in strong. This, if that's true, obviously, or at least the underlying crude structure being strong, which usually is indicative of, the bigger players getting involved on the long side. I don't know. I think it's got some legs here, and I think there's not enough on the macroeconomic side narrative to weigh on it, in my opinion. But
as in bearishly.
Yeah. I mean, what is the bearish story right now? It's hard, right?
Yeah. Refineries going on maintenance, but that's,
That's bearish. Bullish the cracks, as in products versus crude. It's not an outright crude thing, right?
No.
But I know what you mean. It could help stocks not draw too quickly.
That, I guess you've got China's trading data is going to come out on Friday. That's going to tell a lot.
But that's another thing, because we were talking about this before, weren't we? So, it's the right way around at the moment for bulls. You've got the macroeconomic argument getting stronger in the West. Even the UK was saying, actually, we messed up there. The ONS, the economy is actually pretty good.
Yeah.
it was never the lowest in the G7. We just got that wrong. Bit sus. But anyway, and the US, of course, pretty roaring economy. It hasn't really stopped, despite all the claims it would. And so that is correlating with the side of the world that has the most supply, or the most unrestricted supply.
Yeah.
So people love to talk about shale oil underinvestment. Absolutely love it. But I think all the indications from quarterly reports from the majors and even independents are, their oil rigs might be going down, but production's going up. Make no mistake. And in a higher price environment, they're going to produce more. It's just, why would they not? So what I'm saying is Western, dealing with more supply issues, especially the light sweet stuff like the WTI Midland, that can be absorbed from, at least on a narrative basis, because the economy is doing well.
Yeah.
Now you go with the East to say, the China's the main demand center there, and that's a weak demand center.
But you've got the sour crude over there.
Sour crude, which is very, very tight.
Yeah.
So that's the right way around, isn't it? So even the Chinese stats, but if you come out and give a bearish narrative, who cares? Like, it's already known.
Yeah.
So yeah.
And I think some of the headlines that are coming out, like I saw Venezuela's oil exports in August down 38%, from a 3-year high. So like, it's taking things in context as well. It's just, reading it, like, what does it actually mean? Like down 38% from July. That was, really, really high. So that's still much higher than we were like this time last year.
So what was that data again?
Venezuela's oil exports.
Oh, sure.
So that's actually sour crude, isn't it? Down in Venezuela? Yeah. So.
Well, I think if you're a reporter or an influencer and you make a claim, you don't want to be flip flopping, and you want to say, okay, well, I said it was going to be bearish, and I've shifted my whole talk to bearish, and I've been doing that for 6 months. I kind of need to hold on to that even as price goes higher. Otherwise, you're just flip flopping. I actually disagree with that. I think the market flip-flops. If you're a trader, do you think you can go, no, I've got to stick to my bearish narrative and lose $20 per barrel? No, you just go, okay, it is what it is objectively, and you need to be bullish one day and bearish the other day sometimes, you know?
And another thing, so we had the US out on holiday yesterday, so that was kind of one thing I was actually watching for today. It was like, you know, it would have gapped up a little bit on kind of thinner liquidity, thinner trading, and I was kind of wondering today
on the WTI basis.
Yeah.
Let's talk about the WTI Brent a bit. So we had a pretty decent rally up to -$2, which is quite a stable range, but it's usually around 4.
It's a -3 now, which
-3.
is still, you know, much more narrow than it was.
So I think this is really important, because it didn't used to matter too much because of the isolation of the WTI contract. But now that there's a lot of oil being exported from the Gulf Coast, which prices Brent Futures, which prices 60%, 70% of the world's oil, it is a big deal. And WTI Brent rallying is very indicative of basically these draws, probably the running out of oil there and exporting as much as they can over, and it's still being absorbed here. So that's a pretty bullish sign as well if it's being absorbed. That's meant to be the main oversupply area, the light sweet side of things.
Yeah, and the fact that that's moving up, you mean it's...
Yeah, I think so. It means it's being exported at high rates. You know?
Just up on screen right now, kind of tying back to what we were saying earlier, if you actually look, so this is a correlation of, you know, different products and crude futures. So we can see the Brent, TI and Murban there, and you can see, you know, from the week to August 24th to the week to the 31st, the big difference from being, you know, positively correlated to negatively correlated, which I think just, you know, absolutely underscores how Brent has just taken off on its own tangent rather than being, you know, product driven, which is we've been seeing, you know, all summer. There is something fundamentally different
on
happening,
the crude structure.
Happening in Brent that's not in the products at the moment.
Okay, no, interesting.
It's turned to a really, really interesting market this week. I think there was like a time for like 2 weeks where more than 2 weeks we were just the same. It was the same. It was bullish EBOB, all this kind of stuff. Gas oil is another interesting one. I know what gas oil is going to do. I mean, we are at a point where it is really high right now. I thought the technical analysis for this was actually quite interesting yesterday, particularly open interest. So if I can grab that up on screen. If you look down the bottom, so you can see the open interest chart here, not really changing much. Even as the kind of contract became more prompt, not moving up. I think the market's definitely in kind of wait and see mode here. And I mean, we're in September now, and we're not really seeing this like stockpiling for winter yet. And we're seeing prices kind of in the low 30s for the prompt crack. I think it's going to be really interesting when the buying starts in this. Are people going to start seeing these levels as really cheap and trying to pile in as quick as possible? Or
what is it, approaching $30 again?
It's 32 something in the front crack.
I don't think, I mean, historically, that's even last year its peak is very high, right? And I think it's just been a weird one, Gasol, the last year. It was the promised land at the beginning of the year. Everyone was piling their risk into long gas oil.
Yeah.
That didn't go very well at all. Big washout. Then everyone's bearish gas oil, gets short, get ironed out. It goes long again. It goes bullish again. And it's an awkward one. I think the product cracks are whipsawing around, and it makes complete sense to me because the refinery margin needs to rebalance itself, right? So the observer, like the kind of generic observer, says, what's the Brent price? What are the refinery margins doing? And as long as the refinery margins overall are positive, you're like, okay, it's a healthy market, and that might be true. But how do you trade the cracks in that environment? Because they've got to align themselves, right? And at one point in 2022, you got so much of a rally in gas oil and gasoline that the margins were just like stupidly high, like too high. So everyone came in to hedge them. Refiners, some really opportunistic, clever opportunistic refiners rushed in to hedge the crap out of these margins, did very, very well in some circumstances, and actually bought them back later on in the year and did very well. But that's always what happens. You get one blowout in a product, the rest of the product cracks have to align to allow for the margin to make sense. Yeah. So it's a really complicated one in some respects. Like, you know, just looking at it from heavy versus light crudes, if you buying or one's too big versus the other, it's going to have knock-on effects on the supply of the products. And so the cracks have to kind of align to make sense of that. And then obviously you have refiners who are opportunistically hedging on the background as well. And I think people find this really confusing when you get like a massive rally in gas oil. And they're like, now the GOFOs are going to have to completely blow out to account for that. Is it why is the fuel oil, or why is very low sulfur fuel oil getting absolutely destroyed? Hammered, Is it because gas oil is just absolutely blown out of the water? And in order for the refineries to realign, or the refinery margin market to realign, something needs to give. Okay, yeah. So that's what's always happening. And this time around, this year, what's happening right now, the cracks generally speaking are more balanced, I would say, less in astronomical levels, but the fuel oil market's so strong.
Yeah.
Now, the fuel oil
really
market's
high.
so strong. Of course, it makes sense because heavy crude's so tight. But as we've seen, so therefore the light relative to the heavy is oversupplied. So you've got a load of naphtha product being supplied on a relative basis a lot more than fuel. So logically, the naphtha cracks have accounted for this, and you've got this big skew on the light ends versus the heavy ends.
Yeah.
But now the WTI Brent gets stronger, people are buying up WTI, like it's looking healthier in the economy, and all these the cracks are shifting around again, and they are indicative of like the market trying to figure out itself. Now, I think it makes complete logical sense that the gasoline's kind of bit back down, like it's starting to fall down, and naphtha is now also collapsing.
Yes.
And the pro naps as well. Everything's kind of aligning on the light end side, but the heavy's still trying to figure out what it's trying to do. And fuel oil, as you were saying, like one big player came out and sold the other week, and suddenly everyone sells because the market's too long.
Yeah.
But if the market gets washed out and completely tubes, then what's going to happen to gas oil cracks? They can afford to rally now.
Yeah.
So I think the gas oil cracks are a bit randomly high. It's not like anyone came out and said like, this just makes so much sense. I think it's a readjustment.
Does it
of the
not
crack.
make so much sense though fundamentally, because this is going to be the first winter without Russian diesel flows officially, because we didn't come in with that ban until February this year. So this is actually the first winter fundamentally that it should be tighter, because we don't have the Russian diesel, or shouldn't.
Yeah, there's a story there, but I guess are you saying that there's actually real buying that
you could no, I don't think we're seeing it right now, and it's that's reflected in the open interest. It's kind of in no man's land.
So it's being allowed to gravitate up. That's what my point is about. So how do all the cracks interrelate, the differentials? Yeah. So if a lot of people trade RBOB versus heating oil independently, but obviously the flows are still going to go there. So if you sell RBOB heat as a refiner to lock in, the levels that you can produce gasoline versus heating oil, then naturally that selling pressure is independent of the cracks, but it's still going to add to the flows. This is still going to have this balancing effect. So do you see my point? So GOFO linking the fuel oil with gas oil or heating oil versus RBOB, RBOB into naphtha, gas naps, pro naps, they all link together, and all their independent flows are rejigging everything. And I'm just making the point that I don't see the outright buyer in gas oil going, no, it's all about gas oil. So gas oil's allowed to rise because of everything else in conjunction. Do you see what I mean?
Yeah, no, I do. And something also to think about, I guess, fundamentally is also you've got like China exports coming into Europe, so that's something that could weigh on it. And also,
well, I think that might be why people are tentative to be long gas oil from a narrative basis, yet they're seeing it rise. So
also, because I think those exports were actually, I mean, there was rumors all month, and they actually their official statement came out a lot later than people were expecting, and it was on the lower end of expectations anyway. So I think it's an interesting one. I can't wait to see what actually happens going forward.
Sure, but I think for a trader, I would have said it's a shift in regime. So if we call, it's a flat price environment, it's not worth touching. We don't have much momentum here. You look at the cracks, you look at the relative value, what's out of whack, what can be bought and sold against each other, and I think that's what people were doing. And there's a lot of attention on gasoline, and a lot of attention on gasoline versus naphtha, which, again, the gas nap went to all-time highs again. And it's like, that's, pretty significant, well, maybe not, but very high. And that's a really significant thing to happen. And people put a lot of their money there and did very well. Yeah. But now it's like, well, that's kind of come to an end of that regime, because actually everything's rejigged enough with the OPEC cut that there's clarity again in the underlying macro crude structure and oil structure, that you can just get long generically flat price and spreads, and maybe crack spreads, or maybe product spreads. But I think it's not a good idea to be operating in the minutia now, because it's a shift of regime. Do you get my point? And
so go bigger rather than these.
Go more generic, go more vanilla than the relative value, because
that's this week's trade idea. Just long flat price.
Pretty much. I mean, you just ride the momentum. But I would also argue that fuel oil in particular is very dangerous, because it still makes logical sense why it should be strong. And the narrative's still there, but you've got too many people being positioned long on that. And if you're going to position long on that on a crack basis, you're now fighting what I was saying before, which is, but now crude's rallying. Fuel tends to have an inverse relationship to crude. Even though the sour market's tight, heavy sour market's tight, with the market so speculatively long and saturated long positioning on fuel, it doesn't matter that it makes sense. I think you park that one and you move to the more generic trades, is my personal opinion. So when you say interesting, I think interesting, but it won't look interesting. It will just look quite orderly and steady, I think, for the time being, until we start a new regime. You see what I mean?
You don't think cracks will just tank? If fuel oil cracks will just tank?
No, they could. That's what I'm saying.
Yeah,
but the
yeah,
market's
no, I think
long. So I'd say, but they're like, yeah, but the narrative still makes sense.
Yeah, I know.
Yeah, you know?
Yeah. Well, it makes sense for a few more weeks. And then I think that's why I think, and the same with gasoline, you know, you had this like summer demand narrative and you had all these refinery outages. Now, I guess, I mean, refinery outages and strikes, they're always on the back of people's minds in you know, gasoline. But I think in terms of like, oh, you're bullish summer driving demand season, I think it could come down quite aggressively.
Yeah, sure.
Because it's the same thing as fuel oil. I think it's very oversaturated to the long side. I think
Okay.
it's going to take, you know, one or two big sellers and people will panic and it'll come
It's
down again.
kind of been happening then.
So it's not that low.
But I'm saying, if you, again, going back to this rebalancing argument, if fuel and gasoline have been allowed, and naphtha have been allowing to go weaker on a crack basis,
yeah,
by definition, gas oil cracks can be afforded a rally to rebalance the refinery margins.
yeah. I mean, you're down at, I mean, we were at over $18 per barrel last week in the Oct EBOB crack. We're now at 14.
Right. Well, there you go.
So I mean, that's quite a big come down in a week. And it hasn't
Because
really
the refinery
been
margin
big news.
needs to rally if there's an undersupply.
Yeah.
Is it on a fundamental basis? So at the end of the day, all the evidence in the world that the last OPEC cut has done to the physical market what it was intended to do finally.
Yeah.
And you've got the crude structure rallying on a physical basis. You've got the stocks drawing. So the refinery margin has to go up, but how does it go up? And I think because of all the long saturation in fuel and gasoline, and even in naphtha, there's a lot of short covering rallies.
Yeah.
The only thing that can really logically rally right now to keep the refinery margin high is gas oil.
Yeah.
So there's an argument for momentum buying that as well, although you are looking at quite high levels, like you say. It's a bit of a risky. I would just avoid it, let it play out, and the momentum trade on crude seems to be there.
Yeah. We can leave it there then. That's a trade idea.
Yeah, cool.
Long flat price.
All right, so let's leave it. What else do people be looking for maybe the next couple of days, week?
Next couple of days got to be EIA stats. I think anybody that wants to be short is going to, you know, if those are, you know, a build or at least, you know, weaker than, we haven't actually got the forecast yet from the EIA of what they expect it to be, and it's also not going to come out till Thursday.
Oh, okay.
Because of the holiday. So it's going to be a day later. So we have API tomorrow. I think anyone as well looking for an excuse to take profit at these highs, I think will be looking at those as a reason, quote unquote, to actually, you know, sell. And then obviously you've got the Chinese trading data. I guess if that's really, really strong, and if you've got indicators of demand coming back, yeah, exactly. Because then you have a tight sour crude market and a high demand.
So I would argue that what you're looking for in the next few days in a week are the headlines.
Yeah. Yeah.
Do these narratives come back in? Do people start reporting on oil again about, and they do, right? I mean, BBC was saying the price of fuel is up £4 a litre. You know, this is lagged. We knew this already because gasoline cracks were doing so well, but that because now flat price is rallying, that's going to keep happening. So there's stories that are going to brew, and the more that they're in the headlines, the more when you put your oil in Google for news, the more headlines you see that are pumping this narrative, the more I think that the momentum will be there, and then we'll look at the open interest stats, and I think there's a case for it to be, you know, probably $5 to $7 room of momentum rally in the outright prices, and
the upside.
I think so,
90,
from a momentum basis.
Okay.
Because you can break through 90, then people who are saying it will never get above 90, their new narrative there. If that's then tested, then there's stop outs there. Then everyone gets overexcited, and then you kind of wash out to the upside. But anyway, let's not. I think that's what people should be looking for. If on the other hand, it's pretty stagnant, it might just take a while for the market to get revved up again and believe this new narrative, because people have been so burnt in the last 12 months.
Interest rate hikes are another thing. I mean, if they do decide to actually go ahead with, you know, the next hike and not pause, like I think the firm belief now is they're going to pause. I mean, I can't see it. The inflation's down, right, in the US. And the UK doesn't really matter, but the UK new economic data could be like, okay, we do need to really ramp up rates. But again, I don't think the UK is a huge deal. Don't know if the UK, but if the Fed decide, you know, one more
unexpected
for the road,
so anything unexpected
is gonna, I think it's more the unexpected to the downside now, though. I think like the Fed interest rate hikes, or, you know, a massive build in stock, something like that. I think it's more of a surprise to the downside in the next coming days I'll be watching out for.
Okay. Interesting. Thank you very much for that, Audrey.
That was great.
And we'll leave it there. We've also got a special episode that I'll leave listeners to find for themselves coming up at the next episode. But of course, after that, we'll be back in the market talk, probably with Audrey again and maybe some others. Thanks, listeners, and see you soon.
Thank you.